Did you know that Warren Buffett made 99% of his wealth after turning 50? It just goes to show that investing for the long haul really pays off. Warren Buffett is widely considered one of the most successful investors in history, with a net worth of over $90 billion. His investment philosophy has been closely followed by investors around the world, and for good reason. By focusing on long-term growth and passive income, Buffett has been able to build a vast fortune that continues to grow to this day. At the heart of Buffett's investment approach is a commitment to thinking long-term. He's not interested in making quick profits or trying to time the market. Instead, he looks for high-quality companies with strong potential for growth over the long haul. This approach has served him well over the years and is a key part of his investment philosophy. So why is long-term growth and passive income so important? The answer is simple. It's the key to building real wealth over time. By focusing on slow and steady growth, rather than quick profits, investors can build a stable foundation for their financial futures. And with passive income, they can generate wealth without having to actively work for it. Investing for the long term isn't always easy, of course. There are always going to be ups and downs in the market, and it can be tempting to get caught up in the short-term noise. But Buffett's approach has proven time and time again that it's worth taking a step back and looking at the bigger picture. One of the biggest challenges investors face is the temptation to chase quick profits. It's easy to get caught up in the excitement of a hot new stock or investment trend, and to convince ourselves that we can make a quick buck by jumping in. But the truth is that most get-rich-quick schemes are just that, schemes. They're not a reliable way to build real wealth, and they can often end up losing us money in the long run. Another challenge is the fear of market fluctuations. When the market takes a dive, it's natural to feel a sense of panic and to want to get out while the getting is good. But this is exactly the wrong approach. By selling low and buying high, we're guaranteeing ourselves a loss. Instead, we should be looking to take advantage of market downturns as opportunities to buy quality investments at a discount. The temptation to try to time the market is another common pitfall. It's easy to convince ourselves that we can somehow predict what the market will do next, and to try to make investment decisions based on those predictions. But the truth is that no one can accurately predict the market, and that trying to do so is a recipe for disaster. Investors also face the challenge of information overload. With so much information available at our fingertips, it can be hard to know what to focus on and what to ignore. This can lead to analysis paralysis, where we're so overwhelmed by information that we end up doing nothing at all. Then there's the challenge of staying disciplined. Investing for the long term requires a certain level of discipline and patience, and it's easy to get distracted by the latest hot investment trend or to convince ourselves that we need to make changes to our portfolio. Emotional decision-making is another major challenge that investors face. It's easy to let our emotions get the better of us, especially when it comes to our money. But the truth is that emotions have no place in investment decisions. By making rational, data-driven decisions, we can avoid getting caught up in the emotional roller coaster of the market. Another challenge is the lack of a clear investment strategy. Without a clear plan in place, it's easy to get caught up in the short-term noise of the market and to make impulsive decisions. But by having a clear strategy in place, we can stay focused on our long-term goals and avoid getting sidetracked. The fear of missing out, or FOMO, is another common challenge. It's easy to feel like we're missing out on a great opportunity if we're not invested in the latest hot stock or trend. But the truth is that there will always be another opportunity down the line, and that it's better to focus on our own long-term goals rather than trying to jump on the bandwagon. Then there's the challenge of staying patient. Investing for the long term requires a certain level of patience, and it's easy to get frustrated when we don't see immediate results. But the truth is that slow and steady growth is what ultimately leads to real wealth. Value investing is another key principle of Buffett's investment approach. By focusing on companies with strong fundamentals that are undervalued by the market, Buffett has been able to generate significant returns over the long haul. This approach requires a certain level of discipline and patience, but it's a key part of Buffett's investment philosophy. Compound interest is another crucial element of Buffett's approach. By focusing on generating consistent returns over the long haul, investors can take advantage of the power of compound interest to build significant wealth over time. This is especially true when it comes to dividend-paying stocks, which can provide a steady stream of income over the years. Buffett's approach also emphasizes the importance of educating oneself about investing. By taking the time to learn about different investment strategies and to stay up to date on market trends, investors can make more informed decisions and avoid costly mistakes. Buffett's patience is legendary and is a key part of his investment approach. He's not interested in making quick profits or trying to time the market. Instead, he looks for high-quality companies with strong potential for growth over the long haul and is willing to hold on to them for as long as it takes to realize that growth. Buffett has said that his favorite holding period is forever, and this is a key part of his investment philosophy. By focusing on long-term growth rather than short-term profits, investors can build a stable foundation for their financial futures. One of Buffett's most famous quotes is that price is what you pay, but value is what you get. This quote gets to the heart of his value investing approach and emphasizes the importance of looking beyond the surface level to understand the true worth of an investment. Buffett has also said that the market is a servant, not a master. This quote emphasizes the importance of staying in control of our investments, rather than letting the market dictate our decisions. Buffett's most crucial insight is that staying invested over the long term is key to building real wealth. By avoiding the temptation to try to time the market or chase quick profits, investors can focus on generating slow and steady growth over the long haul. As Buffett himself has said, "Our favorite holding period is forever." This quote gets to the heart of his investment philosophy and emphasizes the importance of taking a long-term view when it comes to investing. By staying invested over the long term, Buffett has been able to build a vast fortune that continues to grow to this day. And by following his lead, we can do the same. So what's the takeaway from all of this? The key to successful investing is to focus on long-term growth and passive income, rather than trying to chase quick profits or time the market. By adopting Buffett's investment strategies, we can build a stable foundation for our financial futures and generate real wealth over the long haul. In conclusion, Warren Buffett's investment philosophy is all about focusing on the long term. By avoiding the common pitfalls and challenges that investors face, and by staying disciplined and patient, we can build a vast fortune over time. Remember, the key is to focus on slow and steady growth, rather than trying to get rich quick. Thanks for watching, and don't forget to like and subscribe for more content on value investing and passive income. If you're still with me, leave a comment below with your thoughts on Warren Buffett's investment philosophy or your own investing experiences. I'd love to hear from you.